Now we are looking at underwriting. What is underwriting? Underwriting involves understanding the risk, assessing. So when an insurance proposal comes to the person who is responsible for deciding to accept, he has to understand the risk, assess the risk, decide about acceptance, at what price, what are the terms that there will be. We know we have a standard policy wording. They may want to look at additional wordings, additional conditions. And then once it is accepted, also to make sure that they are covered financially, the financial implication for the insurance company of accepting such a risk. So the management of the exposure. So we are going to now see each of these processes in the course of this lecture. So the first process of understanding the risk and evaluating the risk. The insurance company has a standard underwriting policy. What is this underwriting policy? The company has decided up to a certain value of insurance will be accepted under various branches. They may decide about the categories. So you will have some insurance companies saying we are only going to deal with, if you have seen that the new insurance company is coming in, most of them start with motor insurance or health insurance. Then they move on to fire, to engineering, to liability. So they move on based on a certain philosophy. So the underwriting policy is defined annually by an insurance company's management, and based on that we will do this business, and as it grows let us see and how we have to. They also decide on which territories they will target, what types of clients they would look at. So all of these policies are defined by the management, based on which the underwriters now, once the policy is in place, they have to go forward and see that what business is acceptable to the company is brought in. So how does that process start? So when a customer comes for insurance, the customer will be asked to fill up the proposal form. Who knows best about the risk for which insurance is sought is the proposer, the person who's coming for insurance. So the proposal form asks a lot of questions. We saw it in our documents class, where proposal form is asking standard questions and also specific to the risk. So from this proposal form, the underwriter will see the nature of the physical hazard. Let us take a simple example. There is a proposer come with to insure his car, and another has come to insure his taxi. They are both cars, but one is a personal use car and one is a commercial use car. So the risk now, what are the hazards? A personal car, because it is my personal, I will take care of it better. I will look after it. I will not be using it very harshly. Whereas a commercial, what is my risk? I am looking at generating maximum revenue. I will be taking number of passengers, number of trips. So I will overwork my vehicle, which will be, it will depreciate, or it will fall in value faster. It will not be as well maintained as an individual car, private car. So there is the physical hazard. The next aspect is where it is being used. Whether it is being used in a city or whether it is being used across the country. All of these have physical hazards, the fixed. A similar thing if we look at in health insurance. A person comes to take insurance. Now the person's height, weight, BMI. The insurance company will get a picture of a person overweight, or for the height, underweight, or some other physical features that are there. All these will be ascertained. The moral hazard is also looked at in the form of, are there many losses have taken place in the past? Do I know about any other things? What is the person's attitude to his work or to the property that is being insured? Many losses, frequent losses. Now the client is a doubtful. So insurance companies look at that picture. The financial hazard is a new concept. whether the person is in financially sound condition or not. There is very often people believe that when businesses are in bad shape, there are lots of insurance claims. Some correlation. So people feel that financial conditions are bad, they are trying to recover insurance claims for their finances. So there could be number of reasons. So financial hazard is also an important factor. If a person is highly in debt, there is greater chances of them trying to recover claims in some manner or the other to pay for their debts. So all of these informations, the underwriter, the person who is going to accept the risk, tries to gauge. So the underwriter is not a marketing person. The underwriter is the person to whom the proposal is sent and they have to make the decision. Now, in spite of all these decisions, this information, the underwriter may look at additional information. Now, if it is a risk that is new to him, it's a factory risk in some area which is not very familiar with, he may ask an engineer to go and inspect that factory. Go and see the condition, the surrounding areas, where is this factory located, what is the access to the factory, are there any natural hazards nearby, whether lakes, rivers, mountainous regions, are the road transportation to that easy or are the road conditions bad, then the maintenance of the factory, what are the precautions, are there fencing, proper fencing, is there security, all that information will be taken. If the power supply is regular or irregular, are there load sheddings frequently, equipments are new or old. So question is, a risk engineer goes and inspects the area and gives a report of all the hazards, physical, moral, financial that he observes, communication hazards that would be made. Today we have internet technology, we have the World Wide Web where we can access information about customers and about such equipments or whatever is to be insured. In addition, there could be surveys done. Local knowledge people from the area or even from within the office who know the client, who know the area could give us some additional information. All of these informations are collected and based on that the underwriter tries to take a decision. So when we look at underwriter's philosophy, normally insurance companies divide the type of business they have into three categories. Retail, which is small customers, individuals, householders, where the packaged products are normally there. Small SMEs or small scale and small and medium industries, so enterprises, so they will look at them a little more cautiously than for retail. And then the corporate and multinationals, some of them will be well-established organizations, so the attitude, knowledge about those companies would be on web. So insurance companies will be more acceptable to such things, but based on all these factors. So in this manner, they work out and they look at, the underwriter looks at the information. After he has got all the information, now to decide what to accept. So at the time of acceptance now, I have received so many. For example, if properties for insurance had come a month earlier from Orissa, the coastal areas of Orissa and Andhra Pradesh, so what would have been the biggest accumulation? With Cyclone Phalian approaching, the chances of losses would be greater, so there's an accumulation of hazard. A cyclone is likely to strike, or there's a river nearby, so factories near the river, which is now monsoon season, and the chances of the river being flooded, a risk accumulation. Different locations, so if I am having an insurance, so as an acceptor, I will look at locations. I do not want all my business from one location, from one geographical area. Insurance is always about spreading of the risk. So by spreading the risk, you can counter losses. So the larger, wider area that is covered, the easier it is to manage. For example, if all of you now are all across India watching this webcast, If you had to be called for a classroom session, we would be able to fit only 60 of you in a classroom, which means there would have to be many lecturers for different classes. Now here we can reach, as of today, we are reaching more than 300 of you across India and the world, Asia and Africa. So we are able to reach wider. So our limitation, geographical limitation is not there. It is a vast area that we are covering. So we have spread our risk. We have spread the news. So what is the chances now of accumulation hazard? Less. Because you are all not in one location. There will be some of you who are having load shedding and are unable to hear this or see this telecast. There will be some others who are getting a clear view because everything is fine. So, but it is not in one location everybody is affected. Other locations everybody can see. So, underwriter has now seen the geographical limitation, has seen what is the hazard. Now, he does not see just this risk. What are the other insurances we have accepted from these areas? And based on that, the next aspect is how much is the insurance to be taken. So, how much is the insurance now for these areas? Geographical area. I have 1,000 policies covering householders in Mumbai only. And my risk is now high. Other places, there are only 8 or 9 policies in small towns. So geographical limitation that if there's a loss, if there's a flood or major peril in Mumbai, maximum loss to the insurance company. So limit of indemnity. How much insurance is there being taken? So insurance companies' limit or liability is limited to the sum insured. Whatever is the sum insured, that is the maximum payout in the event of a loss. So sum insured is the final figure, not more than that will be paid out in a claim. So once this is known, the acceptance now, he's seen that, okay, I am meeting my underwriting policy of the company, then now decide that this is acceptable, I am insuring this, but on these special terms. So normally the terms would be there will be an excess. As you all know, excess deductible, what does it mean? From every loss, some minimum amount which the customer will have to bear. So when a policy has an excess of 10,000, it means from every loss that takes place, 10,000 will be deducted. So a loss of 3 lakhs less 10,000 to 2,90,000 will be the maximum payout. So in this manner, excess is placed. Warranty is a specific, we have seen in conditions and policy terms, a warranty is a condition that has to be met and followed by the customer at all times. So a warranty can be placed that the customer will keep security guards at all times, warranted that 24 hours security will be in place on the insured site. The customer has to follow it strictly. So warranties are normally added onto a policy to reduce the risk or to reduce the accumulation or put some conditions to meet the requirements of the insurance company's underwriting policy. Exclusions we saw in every policy, there are standard exclusions, but additional exclusions can be put in based on the risk. So we have today a very common exclusion that comes up, that whenever money is being withdrawn or deposited, that person who is withdrawing the money must be accompanied by a security guard. Now when such warranties are placed or exclusions are placed, these have to be followed at all times. After these terms are decided, the customer now decides, the underwriter now tells you the premium. How does the premium work out? First, the premium, the lowest, the basis on which an insurance premium is worked out is to get the last claimed average of the losses that have been paid in the last few years. Normally 3 to 5 years losses are averaged out, and that becomes the minimum amount that has to be recovered from the policy holders of that product. So this is known as the pure premium. Based on this pure premium, the insurance company will put in some additional terms, increases to cover their administrative costs, to cover the costs for bringing the business, the marketing costs. They will be loading that. Thereafter, they will look at any additional risk that may happen. So they have to also provide for a major loss, or what we call catastrophe loss. A catastrophe loss is when many people get affected by an event. For example, the cyclone is a catastrophe loss. It's a natural catastrophe, it's a major loss. An earthquake is a catastrophe loss. If a forest fire breaks out, we see in Australia, in USA, there are forest fires. Large properties are lost because of those fires. That's a catastrophe loss. So when many people are affected across, there is no differentiation between groups. Everyone gets affected. It's a catastrophe. So these catastrophe losses also have to be provided for. A riot situation is also a catastrophe. A major terrorist strike could also be a catastrophe. So all of these things, depending on the nature and the extent, becomes catastrophes. So catastrophic losses, some element has to be provided for that. Then discounts may be given because of features or investment returns that their insurance companies are getting. So they may discount. In addition, there will be client-specific details. So all of the basis of factors, a client who has had a long relationship with an insurance company will be given additional benefits. If the loss ratios are bad, there will be loadings for the premium. So all of this comprises the final pricing. And a good customer gets better pricing. A bad customer has to pay more. What most insurance companies look at standard risk, so that they can insure more properties and keep under control for their business. So the underwriter has now accepted the policy terms and conditions, worked out the price. Now the next step would be to manage the exposure. So an insurance company has a capacity. We all know a company's paid up capital. So can they have insure more than their paid up capital? That would not be possible, in which case a major loss could result in the company going bust. So what do? Exposure is defined. They try to keep the risk minimum in various ways. So as first the underwriting policy is already defined. So the underwriter looks at how many of the same in this industry, how many of my clients are for this industry. For a client, he may look at, say, pharma industry. He seems to have a lot of pharma industry clients. Now the problem is, when you are biased to one particular industry, then the losses and if that industry is going to difficult times, the exposure becomes greater. So industry-specific exposure would be there, which he will try to reduce and bring other industries. Location-wise, he will try to look at expanding the location. We already saw it in the underwriting aspect. Contingencies. He has also to provide for unexpected contingencies that could happen. There could be a market downturn, there could be financial problems, there could be a natural peril. All of these could affect the exposure. So looking at all this, riots could break out across the country for some reason or the other. So we have to take care of all these contingencies. After he has seen that, okay, this is all the exposures, how much can we retain for ourselves and how much should we pass on? So even an insurance company is looking to reduce its risk. One way is customer may ask that I want another insurance company also involved in this policy, which we call co-insurance. So what happens now? An insurance company's loss has been reduced because another insurer is also there. So two insurance companies are sharing the risk. So an underwriter would be very happy to have co-insurance, because to that extent his risk also gets reduced. Another manner, and which is most common, is reinsurance. An insurance company has accepted a lot of business. Now they look at transferring some of the risk that they have taken on to others. So we have in India one reinsurance company called GIC, General Insurance Corporation, which is the national reinsurer. And it is compulsory for every insurance company on every business they bring to give some of the share to GIC. So we are seeing now a reinsurance. So I am transferring some of my risk to another insurance company. So what is this risk? Reinsurance. Reinsurance can be of two types. One is called facultative. So facultative, it is a specific risk. So if I have taken on an insurance of a major pharmaceutical factory and my limit of exposure in my company is very low, it's only 10% of the insurance for which I have accepted. So I will go, before I accept, I will go to an reinsurer and ask them whether they are willing to share in the risk. So one reinsurer says, reinsurers can be other insurance companies and they can be only pure reinsurers. So a reinsurer will say, okay, I am willing to accept and be part of the risk. So let us see the terms and conditions. I would like you to charge this amount of premium. You should put these conditions. Any changes based on this, on the risk in the course of the policy, you should keep me informed. So no changes can be made without my approval. So individual to individual proposal is accepted on a facultative free. The second aspect is called treaty. So it's an agreement made in advance by the insurance company with the reinsurers that some amount of the business will be transferred to you. So it is on a portfolio basis. So I am saying my motor portfolio or my health portfolio will be transferred to you in some sharing arrangement. These are called treaties. So in advance. So we lay down the parameters for the treaty, and based on that parameter, all the risks that come in that will be transferred to and shared with the reinsurer. So a treaty is based on portfolios. So portfolios can be like fire insurance, generally fire insurance, or it could be related to particular categories of business that we want to insure. It works out commonly given on the basis of the fire or marine or motor in that manner. So another form of reinsurance is the pool. So pooling system is also there, where we find to retain capacity within rather than go overseas. Pooling system is there for in reinsurance, so we increase the capacity to retain within India. So treaty and portfolios are done for the reinsurance purposes. Let us look at our treaties. The first is the proportional treaty. Proportion. So our first treaty, as we have to cede. All insurance companies in India have to cede some business to GIC, and that is a proportional quota share, which is 10% of every risk that we accept has to be shared with GIC. So GIC takes 10% of every policy issued in India. So they share in that. So they get the premium also in proportion. So this is called a quota share. So in more than 10%, now if GIC may take more than 10%, they may agree in some categories, we are willing to take 15. So proportional share 15. More than that, we can look at other insurance companies within India, or we can go to the international markets. We use insurance brokers, reinsurance brokers to look at other markets where we can place the business. Surplus. So here what is there, it has been decided, we have drawn up certain lines. So 10% is gone, 20%, but in the event, say, the total proportion crosses 80% or 100% of the limits that we have set, we want, if it crosses this limit, any surplus will go and be shared with another in proportion to another insurance. So lines are drawn. A line of, say, 1 crore is one line. So second limit is 2 crores, next line is 1 crore, 2 crores, in this manner. Up to 10 crores we have provided for. Now if any risk goes over 10 crores, the excess over 10 crores will be going into a surplus treaty. Again we may say up to 3 lines. So 10 crores, that means 3 lines, another 3 crores. So 13 crores cover can be given. So that is called surplus. Non-proportional, it is not linked to proportion. It is usually to be found in the event of claims. So here we are not insuring the policies, reinsuring the policies individually or facultatively as a group. What we are saying is a particular department, if the total losses in a year which we have to pay out crosses X amount, anything over that will be placed for reinsurance. So a reinsurer will come in for that. So I've decided that 25 crores will be the limit as my insurance company will accept within the country. I will pay up to 25 crores in motor insurance. So if the motor insurance claims cross 25 crores, I have entered into a contract, a non-proportional treaty with a reinsurer, which says that anything over 25 crores in lines of 5 crores up to another 20 crores you will take in as an excess of loss. If it crosses more than that, so that's if the losses go over 45 crores, that's 25 plus 20. I may look at a further excess of loss with another reinsurer or reinsurers. Some may take single lines, some may take more than one line. And the last, the stop loss. So I will all accept up to this. Just if any of you are into investment in shares and for buying and selling of shares, you have a stop loss when you buy. If it goes beyond this price, please sell or buy. So stop loss is in the event, if the price is dropping, please get rid of my shares immediately so that it doesn't go below a certain price. I get a reasonable return. So stop loss works in a similar manner. But it is for insurance claims. So these are the treaties. Now what is special about reinsurance? Why we should take reinsurance? Reinsurance is necessary because reinsurers are insuring properties, taking on risk of properties across the world. So they get statistical data about all types of insurances, all types of risks. So if in India we want to come out with a new product, we can use their statistics to devise our product initially and then fine tune it as the product is sold. So pricing and underwriting advice, they guide us about appropriate rates, how to manage the risk, what are the points that we have to see and then accept. They may also give us guidance on policy wordings. If it's it is a exclusive contract, they will give us policy wordings. They will also guide us on IT solutions about managing and collecting of the data and storing of the data. The people who are handling the product or going to deal with that product, they will be given specialized training on technical aspects. On a regular basis, they will be guiding and advice, so it will be continuously. And any market research and performance controls, they will help us with that. They will also guide in the claims and how to manage the claims, what are the factors to be taken. They may be involved in the claims, coming along with the surveyors, going with the insurance officials to go and check the losses so that they can guide them. These are the points you need to look at. So if you look at the underwriting process, the reinsurance companies are giving good service for new products. In fact, in India, we have used, engineering. All our liability insurances were introduced with the guidance of reinsurers because liability is a very vast subject. Liability claims can occur many, many years later. It impacts the company's finances because the losses will occur maybe 10 or 15 years after the insurance has actual loss took place. So liability insurances we have used under reinsurance. When engineering was introduced, we used the services of reinsurers to guide us on our engineering tariffs and premiums and also policy wordings and technical aspects. So you will see that reinsurance is required to guide and help to develop new insurance products and to develop the insurance market in a country. So reinsurance, coinsurance, all of these aspects that underwriter has to look into while placement of the insurance business. If these things are looked at carefully at the time of acceptance of risk, it becomes easy for the claims technician to then go forward and deal with. So this briefly was a guideline on the underwriting aspects of reinsurance. Today in our session, we have looked at engineering and other miscellaneous policies. We have seen the underwriting process, what the functions of an underwriter, and all the faculties and facilities that are needed for an insurance company to work and ensure that it is financially, it grows its capacity and is able to provide the promise to pay in the event of loss at all times. Now, before we move on to the end of our session, I would like to take up some questions that we have come across for yesterday's sessions. We have a question here. Please explain the simple meaning of subrogation in non-life insurance. So, subrogation. An example again I would like to give. If your neighbor is doing some maintenance work to their home, carpentry work is going on, and the carpenter is using some tools, as a result of which a fire starts in your neighbor's flat and it spreads to your home. So your home is also damaged by the fire loss. Again, for all the damage that has taken place, whom will you ask for settlement? Your neighbor, since the neighbor has caused the fault. So your right is to claim against the neighbor. But it is a fire loss and you have insurance covering your home against fire. So an insurance company is willing to pay you your loss. But they say that you have to take up the action against your neighbor. You have to tell your neighbor, give a notice to your neighbor that you caused my loss, to please repay me the loss that I have suffered. So insurance company has settled. Now they have the right to claim from your neighbor for the amount at which they have settled. But this right will be through a court of law. So those court judgments will take years. You have got your settlement today. Insurance company will then continue the case. You have to start the case. Insurance company continues the case till a settlement is done. So if they are paid more than what they claim that they settled, they have to pay you the difference. If they got less than that, they will have to adjust against whatever they have paid you. They will not recover any money from you. So that is the right of subrogation. Our next question, Pooja Tripathi, difference between hull and cargo. Cargo is goods, consignments. So consignments being sent from one place to another. So you have bought a television and the television is coming from the manufacturer to your home. That is a consignment, that is cargo. So all cargo goods carried in trucks, in railway wagons are cargo. Hull is the ship. The ship is hull insurance. We have discussed catastrophe risk. I have given you now a picture of miscellaneous insurance. We have said, except fire and marine, all the other products come under miscellaneous insurance. Is the charges for debris removal a part of coverage, or do we need to pay extra in the form of add-on? There is a small inbuilt cover in fire insurance of free debris removal cover, and that is 1% of the claim amount. So whatever is the claim, up to that amount, 1% of that amount will be allowed for removal of debris, but you have to show proof of expenses incurred. If you want more than 1% of claim amount, an add-on cover is available, in which case the add-on will provide for up to 10% of the sum insured. This is to be taken at the time of taking insurance. Nemish Mehta, please explain to me about ITC clause. ITC is Inland Transit Clause. So it is marine insurance for cargo moving within India. Cargo sent by trucks and railway wagons or even by air from one destination in India to another destination in India is covered under Inland Transit Clause. So different clauses are there. C, B, A. C is the minimum cover. B and A are wider covers. Sachin Tari, in the floater fire policy, where we don't have breakup of cost good available at each location, if any claim arises from any one location, how the value of goods are calculated? So So you are insuring all your stocks lying at all the locations together. When the loss takes place, the surveyor will inspect the damaged premises. He will look at the accounts. He may go and visit other locations of where the storage is done to ensure that all the locations and what value could be there. And after that, based on his inspections and report, he will decide about what is the total loss that has occurred. What is IDV, Umesh Kumar? IDV is sum insured in motor insurance. So sum insured and IDV are very similar. In other policies, we call it sum insured. In liability policies, we call it limit of indemnity. In motor insurance, we call it IDV. IDV is a insured declared value, which is a depreciated value of the vehicle for which insurance is being taken. So for that value, insurance is provided. Shobi, please, can you define specific policy? Every marine policy for cargo insurance is on consignment basis. So each consignment, so I am sending a package of ready-made garments from Mumbai to Chennai. I will take a specific policy. It is going to one location. But now I have 10 different packets of ready-made garments going to different customers. 3 are in Chennai, 1 is in Bangalore, one is in Delhi, one is in Kolkata. So they will be, each of these will be separate consignments. Insurance can be taken separately for each. So each of them is called a specific policy. Or I will take an open policy and I will give a statement to the insurance company that this consignment is going from Mumbai to Chennai to this A individual. This consignment is going from Mumbai to Chennai to B individual. I am listing out all the consignments and the values, and on that basis the insurance company is reducing my sum insured to the extent of the values, and so many consignments are booked and insured under an open policy. So open policy is just a number of specific policies included under one policy up to a sum insured. Please, can you repeat ICC clauses once again? We do not have time today, but in the course of our lectures in future, we will try to incorporate and discuss on this towards the end of our sessions. What is sunset clause? This is found in motor insurance. In 2003, prior to 2003, the no-claim bonus under private cars was available up to a maximum of 65%. So those persons who were enjoying a no-claim bonus of 65%, in July 2003, this no-claim bonus limit was reduced to 50%. But those who were enjoying 65% are continuing to enjoy the benefit of 65% no-claim bonus till such time they make an own damage claim. So if in subsequent years they make an own damage claim, they will lose that no-claim bonus and they will start from zero again. So sunset clause is to cover those who are enjoying 65% no-claim bonus. Please brief about arbitration. The condition of arbitration says, if there is a dispute on the claim amount, liability being accepted by the insurance company, that means insurance company agrees the claim is payable, but they are willing to settle for only X figure and you want X plus 5. Your client or the insured wants X plus 5, so now there's a dispute on the claim amount. So the client, when they receive the notice of the insurance company that this is the settlement for which we are willing to pay, the client appoints an arbitrator. He writes to the insurance company, I am not happy with the settlement. This gentleman so-and-so is going to be my arbitrator. We will go in for arbitration. If the insurance company is agreeable to this arbitrator, they agree and then arbitration process starts. But if they are not agreeable, they will also appoint an arbitrator. So there will be two arbitrators, one on behalf of the insured, one on behalf of the insurance company. Now two arbitrators Each will have a different opinion. So an umpire will be appointed. Both the arbitrators will sit together and decide a person who will act as umpire to the discussions, and the umpire will make the final decision about the claim amount. This is how the arbitration process is worked out in the arbitration law. What is difference between to floater health and group health insurance? Floater health insurance. A floater health insurance, like a floater fire policy for stocks, one sum insured floating over a group of people. So in health insurance, floater policy is there for a family. So husband, wife, dependent parents and dependent children can have one single sum insured for all of them. Anyone or all can claim up to that sum insured. So that's a floater policy. In group health insurance, there may be, each individual person may have a separate sum insured, or they could also have, it could be a floater policy for a family unit. So when there's more than one person covered under one sum insured, it is called a floater. When it is individual sum insured, it is called a standard single person sum insured. So it can be a floater policy, can be retail, it can also be offered in groups. Normally companies offer group policy as a family floater unit, where employee, spouse, employees, dependent parents and dependent children are covered under the floater policy. So each family will have one sum insured, each family unit has a separate sum insured. Amit Kumar, what is the definition of underwriters? We have now seen underwriting, so you have a picture of what an underwriter is required to do. Bharti Raina, you asked about reinsurance. We have discussed it today, so I am sure you have understood some of the concepts. So these were some of your questions which we have been able to answer. Our time is up for the day, so I will be ending my session. We will meet again on Monday when we continue to look at rating and other aspects of claims. Thank you.